Hello everyone, this is Bhavik Chokshi this side. Hope you guys are doing great. We'll be starting with a few revision lectures for November 2019. This is specifically focused on our November 2019 exams. I'll be uploading a few lectures. Please feel free to message me, write to me if you have any doubts, any problems, and I'll be happy to solve it as soon as I can. Okay, so today we'll be trying to do a summary revision of Ind AS 115. It is one of the most important standards that we have. It's the youngest, at least among what is applicable in November 19. It's an almost sure short exam question to come in your exam. It's a lot of material in the institute, close to 110 sites, close to 60 illustrations. What we'll try to do is, in the short span that we can, we'll try to summarize and wrap up the standard, at least on the conceptual side. I'll not be solving sums over here. I'll mainly be taking you through the entire standard in terms of the conceptual framework. Okay, so let's get to it quickly. So this is a new standard, and why is it introduced? Well, it is introduced because the old AS9 or the Ind AS 18 had some drawbacks. The standard tries to rectify these drawbacks. Took almost a decade for this standard to get finalized, so it's a very, very interesting standard. The standard rests on two main principles. How should revenue recognition happen? Well, the old standard said that it should be based on the risk and reward. The new standard says, well, forget the risk, forget the reward. These are legal terms. Let us look at when the goods and services are actually getting transferred. You try to map the revenue to the transfer of goods and services. Whenever the entity transfers goods and services, that is when revenue should be recognized. The next question that arises, well, at what amount should you recognize the revenue? The standard says you should recognize it at an amount that you reasonably expect to be receiving on account of the transaction. We'll try to understand this better through a very small example. Let us say we look at the example of a sale of an air conditioner. Let us say an air conditioner, a company like Voltas is selling air conditioner for 24,000 rupees. A very typical term in the sale of air conditioner is to also have a free service and a free warranty. So let us say you are getting a 1-year free service and a 2-year free warranty. In which case, Voltas is charging you 24,000. So that is what we call as a transaction price. But against that, what is Voltas promising you? Well, the old standard says that it's a legal contract to sell air conditioner, and as a result, you should recognize the revenue entirely for 24,000 when the risk and reward of the air conditioner gets transferred. Ind AS 115 says, well, let us identify each of the promises in the contract. And what are the promises in the contract? Let us say delivering AC is one of the promises, but not the only one. Apart from the air conditioner, you are also promising to give 1-year service. You're also promising to give a 2-year warranty. And as a result, the performance obligations that Voltas has are essentially 3 performance obligations. So how should you recognize revenue? Not merely when the AC is transferred, but when each and every performance obligation gets discharged. So that is the first principle of the core principle. You recognize revenue as and when you transfer each performance obligation. Well, fundamentally it sounds correct. However, you also need to find the amount at which revenue should be recognized, because on your invoice you will just see a 24,000 number which is attributable to the AC. However, does Voltas standalone give servicing? Yes. Does Voltas standalone give warranty? Yes. Does it give it free of cost? Usually standalone? Well, no. How much does it charge? Let us say it charges 2,000 rupees for an annual service contract. It charges 3,000 rupees for an annual warranty contract, and you have a 2-year warranty, and hence we can say that Voltas expects to receive 6,000 from the warranty. It expects to receive 2,000 from the servicing. In which case, how much is it expecting to receive from the AC? Well, it appears to be 16,000. In which case, how should revenue be recognized? Now that we look at the core principle, it should be recognized in a manner that depicts the transfer of goods and services. The AC is transferred immediately. However, servicing as well as warranty is not immediate. In which case, you should recognize revenue as and when servicing is given, as and when warranty, the repair warranty is actually happening. And as a result, let us say when you receive 24,000 upfront, your journal entry would be bank account debit 24,000, to sale of air conditioners, that is 16,000, to unearned service income because you have not yet rendered service, to unearned warranty income because the warranty period is not yet expired, 6,000. For warranty, 2,000 for the service. As the first year's service gets rendered, you will now recognize the revenue. As the first year's warranty gets utilized, you will now recognize the revenue as unearned service revenue account debit to service revenue, that is 2,000, and similarly for warranty. So you will recognize it at an amount that an entity expects on a standalone basis to receive for the transaction. Are we getting this? Okay. So in order to implement the revenue recognition framework, the standard provides 5 steps. It says that you need to first identify the contract. Second, identify performance obligations. In our example, these were the AC, warranty and servicing obligations. Determine transaction price. In our example, it was 24,000. Allocate the transaction price to performance obligation. In our example, were 16, then 2,000, and then 6,000, and then recognize the revenue. As and when you discharge performance obligations, you will recognize the revenue. Okay, so that is the 5-step model. We discuss each of these steps. The first step is the least important among all the steps, identification of contract. What are we covering over here? We are largely covering contracts which are basically enforceable, usually, because these are terms that are covered under law. As you have studied in the Contract Act, what is a contract? It's an agreement which is basically enforceable by law. However, in an accounting setup, we look at a few more things for it to be satisfying the criteria of something called as an accounting contract. Sorry. The terms should have been approved by the parties. The parties should have terms which are approved. It is not a contract under negotiation. It is something which has been finalized. The rights of each of the parties are identified. For example, if you take a painter for your house, we are very clear that what is a painter supposed to do and what rights does he have under the contract. Payment terms, how much are you expecting to pay? How much would you be paying? How much is the painter expecting to receive? Has commercial substance. You would have probably studied this under the standard on PPE. Commercial substance means there's an actual genuine transaction. If there are 2 shopkeepers, both of them selling, let us say, Alan Solly t-shirts, if both of them enter into a barter to sell those exact 10 t-shirts with each other, ideally it's a barter, gets recorded at fair value. Standard says, why should you recognize any revenue at all? Forget about fair value, forget about WDV. The transaction is on paper, it's not a real sale, and as a result, there will be no revenue recognition. Well, it's not an accounting contract. It might be legally enforceable, but from an accounting perspective, we don't count it as a contract, and hence no revenue recognition will happen in such a case. Collectability. Now, you might have certain situations where someone comes to you, your relative, let us say, and you have to sell goods to them. Now, we don't expect to receive money from them, but the general discussion is, well, we will give you money at a later stage. You don't expect money to be collectible. In which case, the standard says, if money is subsequently not collectible, ideally, you should recognize a bad debt at a later stage. But from inception, if you think that the money is not collectible, it does not make sense to first recognize revenue and then reverse it. Rather, you do not recognize any revenue at all. Well, there is no accounting contract, so there's no question of recognizing revenue if there's no contract. The first step only does not work. Okay, so this is the basic about contract. Remember, we're just discussing largely the main basic points. A few key points that we would want to discuss over here is, first is combining contracts versus segmenting contracts. All revenue recognition is covered under this standard, and as a result, if it is revenue either on a construction contract or a regular asset, it does not really matter, it gets covered under this standard. Should you recognize revenue from each contract separately is what we call as segmenting, or should you recognize the revenue considering all the contracts together? The general principle is you should always segment, recognize revenue for each contract separately. Like in AS7, you would have studied stage of completion of each contract is different, and hence you should recognize each of the contracts separately. So generally, you should segment, recognize revenue separately. However, is combination possible? Can you combine the contracts and show it as one? Well, the standard says it is possible only if the contracts are negotiated as a single package at the same time. They are subject to a single performance obligation. For example, let us say the Himachal Pradesh government comes up with a contract for 5 dams. It is a all or nothing contracts. So 3 times are profit making, 2 times are loss making. But if you want to take the contract, you have to either take all 5 or you have to take none of them. In which case, should you recognize the revenue on each of the 5 dams separately as separate contracts? Well, the standard says no. They're negotiated as a single package. It's an all or nothing contract. They're subjected to one common profit margin. You have probably accepted the 2 loss-making contracts because you have the 3 profit-making ones. And as a result, you should do combination. You should recognize revenue considering all the contracts as a single package. Okay, then is contract modification. Now ideally this is something that I would prefer you to do after you have done step 2 as well as step 4, but in the flow that is there in your study material, we just discuss it right now. What do you mean by contract modification? Well, if there is a change in the contract, you have earlier ordered 100 kilograms of rice at the rate of 1000 rupees. Now you want another 50 kilograms of rice, but now the new price is 900 rupees. So should you consider the entire contract as one single contract, or should you consider them as 2 separate contracts? So when the first 100 kilograms are delivered, you recognize revenue at 1000. The next 50 are delivered, you recognize revenue, let us say at let's say 900. In which case, standard gives you 2 tests. It says that does the new obligation become a distinct performance obligation? Is it a distinct performance obligation? And does it have a separate standalone selling price? 2 things. Is the performance obligation distinct? Second, is there a separate standalone selling price? So these are the 2 things that we need to check. Well, distinct and separate standalone selling price is something that we discussed at a later stage. So for the time being, if it is distinct and if it has a separate selling price, remember, we should account it as a new contract, which means as and when the first 100 kilograms get delivered, assuming they are distinct, recognize revenue at the rate of 1000. The next get delivered and you recognize revenue based on 900, the agreed price. So if one or none of the conditions are satisfied, then what we'll have to do is we'll have to account it as a contract modification. What do we mean by contract modification? You'll have to adjust the revenue on a cumulative catch-up basis in the language of the institute. What does that mean? So let us say if you had contracted with someone to do a particular household painting for your house, and he had estimated that it will take 100 hours, and 100 hours he was charging to you at the rate of let us say rupees 10 per hour. Now you need another coat of painting, and you say that, well, we need you are doing a single coat of painting, we need another coat of painting, and hence the work gets modified. You need work for another 100 hours, and for the next 100 hours the painter charges you, let us say 8 rupees. In which case, if these 2 works are not considered to be distinct, it is quoting on the same level of the asset. Let us say if it is not considered to be distinct, in which case you will record the entire work based on the entire outputs. That's 100 hours into 10, that's 1000, and that's 100 hours into 8, that is 800. So we will say that for 200 hours you are going to charge 1800 rupees, and hence the rate per hour is rupees 90 per hour. If you have already recorded revenue, let us say 50 hours of work have already been done. If you have already recorded revenue, then let's say you already recorded revenue for 50 hours. So you would have recorded at 50 hours into rate rupees 100. That is, let us say 5000 rupees. In which case you would say that ideally now the revised revenue should be 50 into rupees 90. If it is a contract modification, it should be 4500, and hence there will be an adjustment of 500 to be done, provided either there is no separate standalone selling price or the 2 services are not distinct. What is distinct, what is separate standalone selling price, you will come to know in your step number 2 as well as step number 4 if you have already studied that. Okay, so this is about contract modification. Ideally, institute has given it over here, so we discuss it alongside, but ideally it's better to be done after step 2 and step 4 are covered respectively. Okay, next we go to step number 2. This is on performance obligations. What do we mean by performance obligations? Well, basically these are promises. These are promises to transfer certain goods and services which have been already agreed to. So this is nothing but a promise. When are the 2 performance obligations or when is it counted that there are two separate promises? Well, if they are distinct, if goods and services promised to be transferred are distinct, that is when you have to account them as separate performance obligation. And what do you mean by distinct? This is something which I would reckon as very, very important. So distinct is having two features. First, due to that promise, the customer should get some benefit. Now this is generally a condition which is generally complied only. So in our example of AC, warranty as well as service, it is generally assumed that the customer is going to get benefit from the AC itself, from the servicing done, as well as from the warranty. All of them are going to give benefit to the customer, each of them. So what is more important, the second condition, a promise is something which is separately identifiable from all the other promises. A particular promise which is separately identifiable from all the other promises. Now how does that happen? Well, three specific things that have to be proven in the negative. When do you see that one promise is distinct or separately identifiable from the other promise? So it is like saying that is the delivery of AC distinct from the servicing? Well, it is distinct if three conditions are satisfied. First, it should not be a part of significant integration activity. Second, it should not be customization or modification of an existing asset. And third, they should not be highly interrelated. We'll quickly discuss examples on each of them. For example, if you give a contract to someone to construct a power plant. Now, constructing a power plant will involve a lot of work, like doing the piping, doing the electrical fittings, like generating, making the turbines, etc. Now, all of these, when done together, the power plant will be ready for use. And as a result, they might be distinct promises to do wiring, to do piping. All of these might be distinct promises. However, each of these distinct promises are going to result in a performance obligation, which is it's a single integration activity. And as a result, we don't consider this to be separate performance obligations. Or if you go to a software engineer and tell him to assemble a PC for you, you will tell him to take a particular processor, let us say an i5 processor. You will tell him to take a particular motherboard, a particular hard disk, a particular RAM. Now all of these are separate promises that he has to honor. However, all of these activities result in a single integration activity, that is the assembly of a PC, and hence we consider that there is a single performance obligation, not distinct. If all of these are a part of a single integration activity. However, if you go back to our example of AC and servicing, that is not a part of a single integration activity. It is not a part of a single getting the AC in the ready to use condition, and hence we consider these two to be distinct, the AC and the servicing, but we do not consider the PC assembly services to be distinct. They are considered to be a single obligation. That is the first thing. It should significant integration services should not be provided. Second, there should not be significant customization or modification. Now the logic behind this is, if you are already working on the customer's asset, you are actually working on something that the customer already has. And as a result, whatever services you are rendering, the customer is getting benefit. So something like a painter, when he's painting the house, he's painting the customer's house. So as a result, if this painting activity or any activity is happening on the customer's asset, we kind of believe that you are doing a customization, a modification of the asset only. They are not considered to be two distinct obligations. Another example that we can quickly discuss on this is, let us say you are implementing an ERP package, like a SAP package, SAP, an accounting package in your organization. Now, your organization has very complex requirements. SAP is an accounting software, like Tally is a simplified software, SAP is a complex software. Your organization has requirements of a lot of customization requirements on the ERP. Like you are an airline company, you want the SAP to take the data directly from the servers, want to issue receipts for customers, a lot of customization required. So what you are actually buying is a customized software from SAP. You are not buying software separately and asking to do customization separately. You are buying one customized software from SAP. So it should not be resulting in a significant customization or modification. If it is, we don't count them as separate. We don't say that customization is a separate service and the software package that you are buying is separate. We are counting it to be single. We are counting it to be a single SAP software package purchased. Okay. then they should not be highly interrelated. What do you mean by interrelated? Well, two promises should have connection with each other. Now, generally they do have connection. However, the standard specifically emphasizes and uses the words highly, and as a result, you don't want them to be highly interrelated. They might have some interconnection, but they should not be highly interrelated. If they are, they will be treated as a single performance obligation. For example, if you buy a data connection which has voice as well, your SIM card which has a voice as well as data connection, and the company tells you that once you exhaust data, the excess amount of voice can also be used. If you exhaust voice, the excess amount of data can also be used, in which case both of them are highly interrelated. And as a result, if both of them are highly interrelated, then they are not treated as separate performance obligation. But if your if your service provider says voice is separate, data is separate, you exhaust data, well, voice, credit or balance cannot be used, then they are not highly interrelated. There might be some interconnection, but they are not highly interrelated. So if two promises are separately identifiable, that is, they are not a part of a single integration activity, they are not customization on an existing asset, and third, they are not highly interrelated, that is when we count them to be distinct. And if they are distinct, they are two separate performance obligations, two separate promises. If they are not distinct, they are considered to be a part of a single performance obligation. Okay. Then there is a series requirement which is not as important, but if you have, let us say, if you have a cable TV connection, and cable TV connection, or you have taken a newspaper subscription for 1 year, that means the newspaper company has promised you to deliver 365 newspapers throughout the year. So basically it has 365 promises to deliver you 365 newspapers throughout the year, and as a result, ideally it has made you 365 promises. However, as the pattern of transfer is same on a daily basis, the standard says that all of these can be counted as a single performance obligation and not 365 different performance obligation, as long as the pattern of transfer continues to remain the same. So if there are a series of performance obligation, they will be treated as a single performance obligation if the pattern of transfer for each of the promise is similar. Okay, so that takes care of performance obligation. Now there are a few special points that we would want to discuss over here. One is the point on principal versus agent, a very straightforward point. How should principal recognize the revenue? On a gross basis. How should agent recognize the revenue? On a net basis. Net basis would mean commission only. So if you buy, let's say, Tatkal tickets through an agent, you pay him 500 rupees for the ticket and 50 rupees as his commission. So you pay him 550 rupees. The agent will not recognize 550 because his revenue is only the commission element, and hence he will recognize only the net revenue. On the other hand, if you are dealing as a principal, in which case you will recognize the entire amount as a revenue, the gross amount will be recognized as revenue. So if you go to a bookstore to buy a book, the bookstore is not the publisher. He will buy the book from somewhere and he will sell you the book. But he will not just recognize the gross profit as his margin. Why? Because he's selling the book to you as a principal. He will give you the invoice for the entire book on his own name. And hence he's acting as a principal. Now what are the indicators that a particular entity is a principal? Three main indicators. First, the entity should be responsible to fulfill the service. So the book vendor is responsible on selling the book. Second, he should bear the inventory risk. So if he buys the books and people don't come and ultimately take the books from him, he's bearing the inventory risk. And third, he should have pricing discretion. So usually vendors do sell at MRP, but every product does not have an MRP. And even if it has an MRP, it's a maximum retail price. You can always sell at a price which is lower than that. And as a principal, I have discretion. So if I'm responsible for fulfillment of the service, if I'm responsible or if I bear inventory risk, and at the same time I have pricing discretion, that is when I say that I'm a principal. And if I'm a principal, I should recognize revenue on a gross basis. Okay. So this is on principal versus agent. Then you have upfront non-refundable fees. When we are looking at upfront non-refundable fees, a lot of controversy used to arise that if I'm paying an upfront fee, how should I account for it? We'll take two specific cases over here. Standard gives you guidance. If the upfront fee comes along with a separate performance obligation, then you will recognize revenue on the upfront fee generally immediately as that performance obligation gets discharged. However, if the upfront fee does not come connected with a performance obligation, it is just a medium for future services to be rendered, then no revenue can be recognized immediately because there is no performance obligation. For example, if you take a membership to a gym and the gym says that on membership there is an upfront fee of 500, but against that 500 you will get a welcome kit which gives you detailed books on various exercises. It gives you, let us say, some gym wear like t-shirts, shorts, etc. In which case the gym is under an obligation. When you pay 500 rupees, the gym is under an obligation to give you the welcome kit, and hence the welcome kit is given, the revenue can be recognized immediately. On the other hand, if you already have a SIM card and you are traveling international and you take the international roaming fee, in which case Vodafone activates international roaming, but then for every call it charges you still a higher amount. In which case, what is the one-time registration fee or activation fee? We don't really have a separate promise or performance obligation on activation. The services are going to be rendered. Vodafone is under no obligation immediately at the point of activation, and hence revenue on activation should be recorded over the period of international roaming service. So if fees are linked to a separate performance obligation to transfer goods and service, revenue recognition happens at inception when the performance obligation is discharged. If there's no separate performance obligation, then revenue will be recognized when future goods and services are actually transferred. Okay, then we go to step number 3. This is a transaction price. Now under transaction price, this is a total value. At what value should you record the transaction? Now usually we should say the value that is apparent on the invoice, that is the transaction price at which you should be recognizing the revenue. Now what is the problem in that? We'll take the example of, let us say, a construction contract. Let us say under a construction contract we have agreed to a fixed fee of 50 crores and there is a performance bonus. For every 1 month that you complete the contract in advance, you are going to get let's say 1 crore as a performance bonus. Now you reasonably expect to complete the project 12 months early, and as a result, should 50, which is a fixed transaction price, be a part of a transaction price? Of course that should be a part, but what about the additional amount? What about the performance bonus? Should that be a part of your transaction price? Now the old accounting standards followed conservatism and prudence, and hence they would not include the extra 12 till the time it is virtually certain that the bonus is going to be earned. Now Ind AS on the other hand makes the principle a slightly different principle, and it says, should you include that extra 12 of performance bonus? Well, it depends. It says that transaction price should be the amount that an entity expects to receive on account of transferring goods and services, the amount that it expects to be entitled to. Now I am not expecting to be entitled to only 50. I am expecting to be entitled to more than that. And hence the standard puts conservatism and prudence aside, and it says that if I expect to receive a particular amount of consideration, I should be recording that, but that also comes subject to conditions, and we'll probably discuss that. Okay, so transaction price is consideration that an entity expects to be entitled, which is excluding the amounts collected from the third parties. So something like GST that you collect from a third party will not be included in your revenue because you're collecting it on behalf of the government. It should not be a part of your revenue, quite naturally. But what about the variable consideration? Should fixed consideration be a part of your transaction price? Always. But what about variable consideration? Should that also be a part of your transaction price? The answer is basically depends. What is variable consideration? Consideration that you might or you might not receive. Should you include variable consideration? In the language of the standard, you should include it if it is not subjected to constraints. If it is not constrained, if it is not restricted, then you should include it as a part of your revenue. However, if it is constrained, then you should not be including it as a part of your revenue. So transaction price is fixed transaction price. Obviously, you should include it, but variable consideration if and only if it is not constrained. We will discuss first how do you measure variable consideration, and second, when is it constrained. Now, variable consideration, remember, can be positive, it can be negative. Positive variable consideration may be like performance bonus, and a negative variable consideration might be penalty for delayed performance. It can be either ways, positive or negative. How do you measure variable consideration? Well, the standard provides you two methods. First, it allows you something called as an expected value method. Now, this is nothing but a probability based weighted average. There will be various outcomes, and you will take probability based weighted average as your expected value. And second is the most likely value method. Most likely value method would mean the outcome which you think is the most likely of the two. When is a particular method suitable? Now, as per the institute's material, generally expected value method is suitable when there is a range of outcomes, and a range of outcomes would mean more than two. And the most likely method is suitable when there is only one outcome. So whether you pass or fail, that is one outcome, and hence you will take the most likely outcome. If there's a range of outcomes, so performance bonus can be 12 crores, 11 crores, 6 crores, 5 crores, you'll attach probability to each of them and find the probability weighted average. So generally from an exam perspective, if there are more than two outcomes, more than two, remember not exactly two, more than two outcomes, expected value method is more suitable. If there is only two outcomes, then the most likely method, ignoring any kind of probabilities, you will not take the weighted average. So if your chance of getting a positive quality control check is 70% and getting a negative check, so let's say your bonus is linked to a particular quality check being approved. So if you think based on your experience that it will be approved, then you will take the entire amount as variable consideration, the entire performance bonus. Then you have constraints in variable consideration. What do you mean by constraints? Let us say we have calculated variable consideration, but should that be a part of transaction price? It depends on whether it is constrained or not constrained. Now, what do you mean by constraint? Constraint means restricted. If you believe that revenue you will recognize now, let us say we include the transaction price and record the revenue now, and if you believe that at a later stage there is a high possibility that you will have to reverse it. So you think that yes, I will receive a positive quality control check and I will get a 1 crore bonus. You include 1 crore in the transaction price. Subsequently, there is a high possibility, it is highly probable that you will not receive the quality control positive check, in which case the standard believes that the variable consideration is constrained. If you are yourself not confident that you are recognizing revenue now, which will not be reversed in the future, then you don't recognize it now at all. However, if you are quite confident that it is highly probable that revenue that you recognize now will not have to be reversed in the future, that is when you think that it is not constrained, not restricted, in which case you will recognize revenue and include variable consideration as a part of transaction price. So what is constraints? Constraints mean in variable consideration that is a significant reversal in revenue already recognized. Is it highly probable or is it not highly probable? If it is highly probable that you have recognized revenue now and you'll have to reverse it later, then you don't recognize revenue now for variable consideration in the first place. Exclude variable consideration. That means it is constrained. If you think that we can include the variable consideration, we don't think that there will be a reversal in the future, then it is not constrained. You will include the variable consideration as a part of transaction price. How will you figure out whether a significant reversal in the future is highly probable or not? Well, a lot of illustrative indicators are given. The strongest among them is like your past experience. If you have done hundreds of projects and this is a similar project, and your past experience clearly points out that you will meet the quality control requirements, then you are confident to say that significant reversal will not happen. However, if it is your first project, then even though you might end up believing that a reversal might not happen, a reversal might happen. It depends on your level of confidence. Something like as basic as your 12th exams versus your CA exams. If you kind of believe, if let's say a variable consideration was linked to your passing your 12th exam. Now based on your experience, you are almost certain that you can recognize revenue. Once you have given the exams, you're sure, even before the results are going to come, that you're going to pass. And as a result, we do believe that variable consideration is to be included. On the other hand, if it is a CA exam, most of the times you're not as confident. It is an exam again. You are given a bonus which is linked to your passing the exam, but you're not very confident. Your past experience does not tell you as much that you will clear the exam or not, and hence we can say that it is constrained. Let us not recognize any revenue. Let us wait for the results. Hopefully we clear and we can then recognize our revenue. So that is what you mean by constraints. Also, external events. If your performance is linked to something like the stock market performance is largely beyond your control. And as a result, if we think that a lot of the factors are beyond your control, we consider it to be constrained. Or the time frame is very long. We are generally broadly sure on what we are going to do in the near future. The moment the horizon becomes long, it becomes slightly blurred, and hence the longer the horizon, the more the uncertainty. So, illustrative factors, you look at your past experience, see if a lot of external factors are involved, look at the time frame, and then decide your confidence in variable consideration. So, the long story short is, if you are very confident based on your experience, internal factors, etc., then you include variable consideration as a part of your transaction price. If you are not very confident, that is, you think that it is possible that a significant reversal might happen, you do not include the variable consideration as a part of your transaction price. Okay, then there is a section on significant financing component. This is a part where time is involved. Transaction price may include something where time plays a crucial role as well. Now, usually, whenever you render goods or services, whenever performance obligations are discharged, that is the point when payment should be made. However, if the payment is made at a later stage, goods and obligations are delivered at a different date, there is a time gap. So, should there be a hidden interest involved? Again, taking the example of an air conditioner, let us say you go to a store and the air conditioner is available for immediate buying at 20,000 rupees. However, if you want to buy it over 2 years, it is available at 24,000 rupees. If you buy the air conditioner, or let's say you are in the books of the storekeeper, if a customer comes and he buys the air conditioners with 2 years credit, your invoice will be made at 24,000. Customer will buy the products now and he will make the payment after 2 years. So ideally, Chroma will pass the entry, or Voltas will pass the entry, debtor account debit, customer account debit, to sales 24,000. 2 years, no payment is going to be received, and after 2 years, you will receive money. You will receive 24,000. So after 2 years, you will pass the entry, bank account debit to debtors, 24,000. Now, standard believes that the time is very long. There's a significant financing involved. If the time gap between the date the performance obligation is discharged and the date the payment is received, if the time gap is more than 12 months, the standard comes with an implicit presumption that there's a hidden loan. Why is Chroma charging you 24,000 more? Is it charging you because you're getting a high star AC? Is it charging you because it has a higher tonnage? No. It is charging you because it is giving you a 2-year time frame. And generally, materiality tells you that if it is less than 12 months, you will ignore the transaction. That is what the standard specifically tells you. And if it is more than 12 months, that is when you should consider. More than 12 months, if the time gap between, remember, the date the performance obligation is discharged, that is when I give the AC, and the date when payment is received, if the time gap is more than 12 months, the standard believes that there is a hidden loan or a hidden financing for which the entity expects to receive some interest. And as a result, over here, if the time gap between the performance obligation and the payment is significant, that is greater than 12 months, there is a hidden significant financing involved. Now, how are you going to find the financing element? Well, the standard says that two things have to be seen. Not every transaction where time gap is more than 12 months will have a hidden financing. So, there are certain exceptions given. And if it is not covered by the exceptions, then we have to figure out what is the rate at which you should take the significant financing. So 2 points we need to discuss. Let us say the time gap is more than 12 months. Let us say we are talking about a complex machinery. Now we buy a machinery machinery is delivered, the buyer is worried that if the machinery does not work up to the specifications, once the seller receives the money, he will not really support. And as a result, in complex engineering industries, a retention is very common. So it might happen that the machinery costs 10 crores, we will pay only 7 crores, we will retain 3 crores, and we will say that 3 crores we will pay, let us say, after 2 years. If we are satisfied by the performance, if there is a fault in the machine, your engineers come and repair it and we'll give you 2 crores. However, if your asset is not as per what you have promised, we will retain the money, not give you the money. So is the retention happening because you don't have money? No. It is happening because you want to be assured about the performance of the machine. And hence the standard says that if the time gap is for a reason other than financing, then you should not assume it to be a hidden loan. On the AC example, there was nothing specified, and as a result we said that, well, if it's a gap of 2 years, it is because the customer does not have money, not because the customer wants an assured performance and stuff, but because he needs time. Over here in the complex engineering equipment, we do need a surety on performance more than the time, and hence there does not seem to be a hidden loan. Second, if the transfer of goods and services are at the customer's discretion, something like prepaid SIM cards, you might buy a prepaid SIM card with the 2 years validity, not use the SIM card for the first 23 months and then use it for the 24th month. Now technically, Vodafone is discharging its performance obligation in the 24th month when you are using the SIM services. You have made the payment at the beginning, but Vodafone was ready to discharge its obligation even on the first day. You did not take it. And as a result, we say that if the time gap is more than 12 months, but the customer had the discretion to use it, he did not use it. And hence, we cannot say that there is a hidden loan. Third, variable consideration is involved. Something like, let us say, authors. Let us say I'm an author and we have agreed, I've given the copyright of my book to a particular publisher. Publisher and the author agree to a sales-based royalty. Now, we will not be able to decide the amount of payment till the time sales happen in the future. So let's say sales happen over a 2-year period, and after 2 years, a particular amount is paid as royalty. Is it because the publisher does not have money? No. The publisher does not really know how much money to be paid because there is uncertainty which is linked to the variable consideration being involved. So if the time gap is linked to factors other than financing, like performance guarantee, linked to a discretionary service, or it is linked to a variable consideration, in which case the standard believes that there will be no hidden interest adjustment to be done. But if these 3 exceptions are not there, then a hidden interest adjustment needs to be done. So the next question is, at what rate should you do the adjustment? The standard gives you a clear order of preference. It says the first preference should be given to the incremental financing rate. If I were to go and take a loan from somewhere else, at what rate would that loan be? Or if I were to give a loan, at what rate would the loan be? That must be the rate in the financing arrangement. If, let us say, such a rate is not available, then we use the IRR, that is the rate at which present value of cash outflows and cash inflows will equal. Then we have the non-cash consideration, so that takes care of financing element. Non-cash consideration, that is barter. As we had discussed earlier, if the transaction lacks commercial substance, there is no revenue recognition, it's not an accounting contract only. However, if it has commercial substance, the standard, unlike the standard on fixed assets, gives you a clear order of preference. The standard gives you the order of preference. It says it should be based on the fair value of the consideration that you are expecting to receive, and hence the first preference should be to the fair value of the consideration received. And if that is not available, then we should look at the standalone selling price of the items given up. Okay, that is about barter. Then we go to consideration payable to the customer. Now, in a usual business situation, consideration is payable by the customer. In certain cases, consideration might be payable to the customer. So, for example, if you are looking at a business where there is a retailer like Walmart and there is a company like Kellogg's who's selling cornflakes. Kellogg's wants to sell cornflakes to Walmart, and we agree that we'll sell 10,000 packages at the rate of rupees 10. But Walmart says that I have my shelves which cannot accommodate your products. So I will have to do some modification on the shelf for which you have to compensate me. So what is happening now is so there is Kellogg's, which is the seller, and there is Walmart, which is the buyer. Now, Walmart is going to pay 10,000 for 10,000 packets into rupees 10, so it is going to pay 1 lakh to Kellogg's, but at the same time Kellogg's is agreeing to pay, let us say, rupees 10,000 for renovation of shelves of Walmart. So this is a consideration payable to the customer. So if the consideration is payable to the customer, what should you do? Should you record revenue in the books of Kellogg's at 1 lakh separately and expenses at 10,000 separately, or should you net this off and record 90,000 net? The standard says that this entire discussion depends on whether the service is distinct or not. So does Kellogg's get a distinct right on the shelf? So if you've been to Shopper Stop, Lifestyle, etc., a lot of times you will see that there are dedicated areas which are kept for a particular brand. If such a dedicated area is kept, then we are getting a distinct service. Then, well, you should record it separately. You should not net it off. There is a separate transaction. However, Walmart does not give any dedicated area to Kellogg's. It says, well, we will renovate, but we'll keep it the way you want, and we'll keep it if we want. As a result, the standard believes that there is no distinct service. If there's no distinct service, it has to be netted off. So the guidance over here is, the first thing we check is if there is any distinct goods or service, or there is no distinct goods or service. If there is no distinct goods, the entire amount should be reduced from the transaction price. If there is a distinct goods or service, generally you will show it as a separate expense and separate revenue, provided it's a fair transaction. So the consideration should be less than or equal to fair value. Then the entire expenses will be accounted separately. However, if the consideration is greater than the fair value, then the standard believes that you might be overstating the expense. And to the extent of your fair value, only to the extent of your fair value, you can recognize distinct expenses. Beyond that, you will have to reduce it from the transaction price. So let us say Walmart is giving dedicated area to Kellogg's. A section in the store is given to Kellogg's. However, the fair value of that section is only 2,000 rupees, not 10,000 rupees. So we say that, well, you know what, 2,000 can be shown as a separate expense because we are getting some benefit, but the excess 8,000 has to be deducted from transaction price. The purpose of this entire adjustment is to ensure that revenue does not get overstated. Okay, so that takes care of the transaction price discussion. There's also a section on sale on return. I think we have not mentioned it in the notes, but generally when you look at sale on return, you will estimate how much goods are not going to be returned from past experience and recognize the revenue for the goods that you expect to be returned. So let's say you have sold goods which are 100, 70% you expect will not be returned, 30% will be returned. So you'll create a refund liability. Your journal entry will be bank account debit 100 to sale 70, what you're expecting to be sold, to refund liability 30. But once you create a refund liability, you will also have to create an asset to show your right to receive goods back from the customer, and hence a recovery asset, because you will give the refund only if you get the goods back. So if you create a liability for refund, you should also create an asset which shows your right to get the goods back from the customer, inventory which is actually lying with the customer. Okay, then you go to the next section, that is the allocation of transaction price. This is a fairly straightforward section. How will you allocate the transaction price? You have determined the performance obligation, let us say in our example sale of AC, warranty, service. You have determined the total transaction price, let us say 24,000. Now you need to allocate it. How will you allocate it? The standard says in a ratio which fairly depicts the consideration that you expect to receive. Now how much is the consideration fairly depicting the consideration that you are expecting to receive? How will you determine the amount of consideration that you expect to receive, which is generally based on the separate standalone selling price? If I were to sell each and every product separately, standalone, how much will I expect to receive? That is the amount that I expect to receive even in a combined transaction if there are multiple performance obligations. So there are two exceptions that are there. First is the pro rata allocation of the ratio of standalone selling price is not suitable in case of discounts and in case of variable consideration. We'll quickly take examples for each of them. Usually performance obligations in the ratio of the standalone selling price we will separate. However, if there are discounts, so for example if you are joining somewhere for 3 subjects, so ideally the subject wise price will be taken as a base and your total combo price will be allocated in the ratio of the 3 subjects individual price. However, if the coaching institute also offers 2 subjects at a discounted price, then you will first allocate the discount to 2 subjects and then go to the allocation for 3 subjects. So basically for discounts, you'll first allocate it to the smaller bundle and then go to the larger bundle. When we look at variable consideration, something like, let us say there's a contract which has construction as well as operation, and the government says that if you perform the construction early, then you will get bonus, in which case the entire variable consideration will be allocated to the construction and not to the operation part. Okay, so that is about the exceptions. Then you look at the standalone selling price. Standalone selling price is usually the observable price that a seller is selling the products himself at, not others, himself. That is the best method. But if that is not available, then the standard gives a few other methods. First is the adjusted market assessment approach. So you look at the competitor's price and make some adjustments to find the expected price. Or cost plus margin approach, where you look at your costs and add an appropriate margin. And the third is a residual approach, from an exam perspective important, which is nothing but the balancing figure, which is what we used in our original example for an air conditioner. A couple of things that need to be remembered for the residual approach. First of all, residual approach is nothing but the balancing figure, as we have written over here. It is suitable only if the entity does not have a separate standalone selling price, does not sell the product standalone, or it sells it standalone but in a very wide range. So if you look at roadside vendors, they sell products at a very wide range. There's no single separate standalone selling price. So it's a very broad range, or you don't sell it standalone at all. Key points: you first allocate discount before applying the residual model. You first allocate discount to all the obligations and then find balancing figure. Otherwise, invariably all the discount will be taken up by the residual obligation only. And the value under residual model should be within the range. So your final answer that you get, if you're having a range of standalone selling prices, your final answer should be within the range. So if you're selling between 300 and 1000 a pair of jeans as a roadside vendor, your residual approach should also give you an answer between that. It can't be 1500, it can't even be 100. So that is about residual approach and allocation. You go to the last and the final step, that is on revenue recognition. When should you recognize revenue? When the performance obligations get discharged. That is when the control of goods and services gets transferred. How does the standard define control over here? It defines it as not as a risk and reward, not as ownership. It says the ability to direct use of the asset and get benefits out of the asset. Your ability to direct use and get benefits, or even an important definition that if you can prevent others from directing use, even still you are supposed to control the asset. So your asset might be made by a manufacturer. Like India has ordered Rafale jets from Dassault in France. Now we don't really have the ownership of the jets now, but we can prevent Dassault from doing anything with the jets without our permission. So we control the jets even though we don't have legal ownership. So your control is your ability to direct the use of the asset if you have your asset with you, or even prevent others from directing the use of the asset. That is when we say that there is control. Now when should you recognize revenue? As and when control gets transferred. Now when does control get transferred? Now control can get transferred over a period of time or at a point of time. More important is an over the period of time definition. If when does control get transferred over a period of time? Standard gives you 3 criteria. Criteria number A: if a person renders service and the other person simultaneously consumes. So it's a simultaneous rendering and consumption of services or goods. Then the transfer is happening over a period of time. For example, you join a coaching institute or you join a gym. The service is rendered simultaneously and the benefits are received simultaneously. Now how do you figure out whether there is a simultaneous transfer or not? The standard says that, well, you should look at the fact that if a new service provider is appointed midway, will he have to redo the entire work, or can he start where the old person left? For example, if you were into a gym contract and after 3 months the gym gets acquired, the new gym will offer you membership for the remaining 9 months, not for the entire 12-month period. On the other hand, if you are an auditor and you have done a significant audit and now you want to recuse yourself, you want to move out of audit, a new auditor gets appointed, you will have to substantially do all the work again, in which case benefits were not being transferred simultaneously. Criteria number A. That is when the transfer is happening over a period of time. Criteria number 2, if you are working or if you are modifying a customer's asset, in which case again, the example of a painter or a renovator, you are actually working on the customer's assets only. And as a result, even if midway things get terminated, you have transferred your services to the customers, which he can enjoy. In which case, the transfer is always happening over the time. As and when I do the painting work, the transfer is happening. And lastly, the most important one, even if there's nothing else, let us say if you have agreed to a situation where the goods have no alternative use. Now, this no alternative use may be either due to a legal compulsion, like a exclusivity clause, which is there in various agreements, or due to the practical constraints, like you're building a satellite. There are not enough people who will buy satellites or a rocket launcher. So even if exclusivity is not there, you're going to struggle to find another buyer. So the goods or services that the seller is making is having no alternative use, and the seller has a right to receive payment based on the work completed. It is not a flat payment, it is payment based on the work completed. If these two are satisfied, again we say that the transfer is happening over the period of time. Three criteria. Criteria number A, simultaneous transfer and receipt of benefits. Criteria number B, working on the customer's asset only. And third, and the most important one, the goods or services that you are offering have no alternative use for the seller except for giving it to the buyer. And in an unlikely circumstance that you have to terminate the contract, the buyer will have to compensate you for the work that you've already done. And hence, the standard believes that in such situations, there's no point waiting till a point of time when you can recognize the revenue. There's no point waiting till ownership gets transferred. If, let us say, take the example of the airlines. We have placed order to receive aircrafts from the French company. Now the French company is making aircrafts. It has no alternative use but to sell it to the Indian company. And if the Indian company midway decides that it does not want to buy the aircrafts, still it will have to compensate the company for what the work has already been done. So the standard believes that if you are going to get benefit, even if the ownership does not entirely get transferred, what is the point of waiting till a particular point of time? You can recognize revenue as and when work is done. So that is when revenue recognition happens over the period of time. What is at a point of time? Well, if the transfer does not happen over a period of time, it's a negative definition, then it happens at a point of time. And the point of time has not been defined, is generally the date when legal ownership, etc. will get transferred, is the point of time. Okay, some detailings given about criteria C. The important one, it can be no alternative use due to contractual or practical limitations, like the satellite example. This is the important one. Payment based on work done. Work done has to be based on cost incurred plus a reasonable profit margin, which can be like your cost of capital or IRR. Remember, a meager compensation or a flat compensation which is not linked to the cost incurred or work done does not satisfy this criteria. It has to be cost incurred plus a reasonable profit margin. If you end up deciding that the transfer is happening over a period of time, you need to measure that over the period of time. So the way in which you measure stage of completion or progress can be an output-based method, like an architect survey where they determine the fair value, or it can be based on an input-based method where you compare the cost incurred, like you used to do in IPCC AS7, cost incurred upon the total estimated cost of the future. That is an input method. How much input you are putting, that is your stage of completion. Key points for an input method is your cost incurred should be only your regular cost, which increases the progress of the project. So if you have an abnormal loss like a flood, fire affecting, that is cost incurred, but that does not increase your progress on the project, has to be ignored. And second, if you buy major materials which you have no real role except for buying it and on behalf of the customer, these are going to be split, separated. So you will measure progress based on the work that you are going to do. So if you have land and building, you are constructing a building, you just buy the land, and land is a very major component. That means 60% of the cost is already incurred. Should you recognize revenue based on 60% of the cost? No. The standard says for that part of land, you are buying it on behalf of the customer. Revenue recognition should be based on the work done. It should be based on exactly the cost incurred. For the remaining part, you will try to measure progress, and revenue recognition will be based on the progress of the remaining part of the inputs. So you'll recognize the revenue up to cost for the major materials. For the other items, you will measure progress as cost incurred for the other parts upon the remaining cost for the other parts. Okay, then you have a special case of sale and reward. This is like a repo arrangement where you might agree to sell goods at 100 and agree to buy it back those same goods without modification after a year, let us say at 110. In which case, is there a hidden, is that really a sale and is that really a repurchase? Standard believes no. Why would you sell the goods at 100 and agree to buy those same goods back at 110? Well, you would agree to do that if probably there is a hidden loan involved. So if you are actually selling it at 100 today and buying it back after a year at 110, then 10 rupees would be the hidden interest. So you will account the transaction as a loan transaction and 10 rupees will be shown as interest. On the other hand, if it is a sale and repurchase, and if the repurchase price is lower, if your repurchase price is it's written the other way around. If the repurchase price is, let us say, 90 and the sale price is 100, then why will you sell something at 100 and buy it back at 90? The standard believes that the 10 rupees is in the nature of rent. It's a lease transaction, and hence 90 is a security deposit and 10 rupees is in the nature of lease rent. And as a result, you'll account this as a rental transaction. Why do you not account it as a sale? Because if there's a repurchase already there, then the buyer does not have the ability to direct the use, or the buyer does not have the ability to prevent others from directing the use. So the seller has control over the asset, and hence there is no revenue to be recognized. I'm selling the goods, but I'm not transferring control. No revenue should be recognized. The situation might become a little more complex in case of options. In case of options, you'll have to see the likelihood of the options getting exercised. If the options are likely to be exercised, then you will account it as a loan or as lease transactions. But if the options are uncertain, not likely to be exercised, then you account it as a sale only. Okay, so that takes care of the 5-step model. A couple of other things, I'll just wrap it up in the next 2 to 3 minutes. A couple of other things that you would want to know in general about the standard. One, there is about contract cost, and then there is a special case about service concession. We'll quickly try to discuss this. Contract cost. Remember, we are out of the revenue recognition model. We have done 5 steps, recognize revenue. 2 special guidances. Contract cost. Contract costs are split into 2 parts. There is contract fulfillment and then there is contract acquisition. What is a contract acquisition cost? These are costs that you are incurring to acquire or procure a contract. These are only the incremental cost. So if it is a cost which is incurred only if you get the contract, and it's a cost which is saved if you don't get the contract. If you get the contract, you incur the cost. If you do not get the contract, you save the cost. For example, if you look at legal fees, if the contract is drafted, then whether you get it or not, legal fees are going to be incurred. So how do you decide whether a particular cost is a contract acquisition cost or not? Well, the standard says that if the signatories to the contract arrive at the signing table and at the signing table they walk away, will the cost still be incurred? If the answer is yes, it is not contract acquisition. If the cost will not be incurred, then it is contract acquisition cost. For example, if you look at legal fees, if the signatories arrive and they do not sign the contract, will you still have to pay the lawyer? Yes. If you have traveled to that place to sign, will you get refund from the airline? No. In which case, these are not contract acquisition cost. However, if it's sales commission, if it's broker's commission, brokerage, if the contract is not agreed, will you still pay brokerage? The answer is no. In which case, it is contract acquisition cost. If it's a cost which you save, if the contract is not signed, incur. If the contract is signed, it is a contract acquisition cost, incremental cost to obtain a contract. What do you do with that? You recognize an asset and amortize it over the lease term or over the contract term. This is what you mean by contract acquisition cost. Then you have contract fulfillment cost. These are costs to fulfill a particular term and condition under the contract. So for example, if you are getting a contract to run a call center on behalf of Vodafone, and Vodafone has certain costs, certain requirements, that you need to have people who wear Vodafone t-shirts, jerseys. You need to have a particular kind of computer, a particular kind of software. These are costs that you will have to incur to fulfill the requirements that Vodafone has, and hence we call these as contract fulfillment cost and not contract acquisition cost. What do you do with contract acquisition cost? Contract acquisition costs are usually recognized as an asset and amortized it over the contract term. What do you do with contract fulfillment cost? Well, we will check if they are covered under other Ind AS. So if Vodafone requires you to buy a computer, if it requires you to buy a software, these would be covered under Ind AS 16, property, plant and equipment. Computers or software will be covered under Ind AS 38, intangible assets, in which case the accounting will be based on the respective standards. Ind AS 16 will tell you how to depreciate it, how to record a computer. 38 will tell you about the software. But about t-shirts, about let's say data migration, these are costs that you will have to incur, and they are not covered by a respective accounting standard. In which case, if they are not covered under a particular standard, then the standard says you will capitalize them, show them as a fulfillment asset, and amortize them over the period of the contract. Remember, in both cases, the standard says that you will capitalize and amortize only if the contract term is more than 12 months. If it is less than 12 months, as per materiality, you can immediately expense them to the P&L account. But if the contract term is more than 12 months, you will capitalize them and expense it off, defer it off the contract term. This is very different as compared to what you have studied in the older standards, but it is mandatory just to ensure matching concept is properly given effect to. You will amortize it over the contract term. And how do you determine the contract term? Well, in the language of the standard, contract term is nothing but the term which the entity expects the contract to continue. This will include even potential renewals if you expect that the renewal is likely. So it's the average term that is expected, not just the term which is non-cancelable. It will also include the renewal period if it is likely that renewals are going to happen. So basically, contract cost you divide between contract procurement and fulfillment. If it is a procurement cost, if it is incremental in nature, then it is procurement, in which case you will capitalize and amortize. If it is fulfillment, you will see if it is covered under a respective standard. If yes, you will do the accounting as per the respective standard. If no, then you will show it as a fulfillment asset and defer it over the contract term. Okay. Then the last part, this is on service concession. What do you mean by service concession? These are like toll roads. Now, let us say if you are constructing highways, bridges, let us say you construct the Bandra-Worli Sea Link or the Mumbai-Pune Expressway. How should you show these assets in your books of accounts? Should you show it as PPE? Well, these are usually service concessions which are public-private partnerships. So the government does not give you legal ownership of the asset. The government says, well, you know what, you construct the asset, and there are two types of arrangements. The government might tell you, you construct the asset, take a lump sum amount of cash and finish it. 2,000 crores for the bridge. You construct the bridge, the government pays you 2,000 crores, the asset is, so it's done. Second possibility, the government does not have enough money. So the government says, well, you know what, you construct the bridge. I don't have money to pay you for that, but the Indian public can pay you for that by using the bridge. They can pay you toll. So the government bestows on you, showers on you, is a right to collect toll. And a right to collect toll is considered to be an intangible asset. So in either case, the standard clarifies under the appendix and says, in either case, this is not a PP. You do not get ownership, you do not get control over the asset. Yes, you have the ability to use it, but that does not in any way give you ownership or control over the asset. So you cannot show it as a PPE. Then how will you show it? Well, it depends. If you are getting a right to receive cash from the government, so the government says, I'm going to pay you 2,000 crores, then what you get is an unconditional contractual right to receive cash. And this squarely fits into the definition of a financial asset. So in such a case, you will recognize revenue, and against that, you will recognize a financial asset. So like you pass the entry debtor account debit to sales, you will pass the entry financial asset or a receivable account debit to construction revenue as and when you will construct, because what you get on construction is a contractual right to receive 2,000 crores from the government. On the other hand, the government does not give you a right to receive cash. So you cannot say that you have a financial right to receive 2,000. But what the government does give you is a right to collect toll. Now, is that a contractual right to receive cash? An unconditional right to receive a fixed amount of cash? No. More people use the road, you will collect more toll. Less people use the road, you will collect less toll. And as a result, what you do have is a right on an intangible asset where you can get future economic benefits. And as a result, this right to collect toll, that is, there is no unconditional right to receive cash, is to be shown as an intangible asset. Your journal entry will be intangible asset account, debit to, let us say, construction revenue. You're not getting cash, you're not getting a financial asset as well, but you are getting a right, an intangible. Government would not have given you a right to collect toll had you not constructed the bridge, and hence this gets recorded as an intangible asset. This is an appendix. Okay, so that does take care of Ind AS 115. I hope this video has been helpful to you. Please do feel free to write to me or message me in case you have any doubts or problems. I'll be more than glad to solve them as soon as I can. If you have liked this video, it would be really helpful for me if you can like it, share it, subscribe to my channel. Thank you very much, and till we meet next time, wish you all the very best. Study well. Good luck. Goodbye.